Accounting for partnership firm. This is our main topic, and the module is about goodwill. Yes, goodwill. Goodwill of the firm. We will learn what is in fact goodwill of the firm. In fact, the thing is that goodwill is aggregate of those attributes of the entity which in fact contributes to the superior earning capacity of the business. Okay. And the second thing is that goodwill is in fact the outcome of an impression that is created in the minds of the customer or employees or the suppliers or other related entities or people. Goodwill is not something that we buy. Goodwill is an intangible attribute that we earn over the years. That is earned by having good dealing with the customers, timely payment of the invoices to the suppliers, good relationship with the human resource or human capital or the employees, good behavior with the public at large of that entity, okay, with the lenders, with the people to whom the business is interacting in any capacity. So this goodwill is earned over the years, and it is something intangible attribute. Okay. So when we are in a business which is progressing for years over years, and at one stage either the new partner is joining that business or the existing partner is leaving that business. At that point of time, we need to calculate goodwill. Or in a way, we can say that as and when there would be a change in the constitution of the partnership firm, we will need to calculate goodwill. Because for that goodwill, we will give benefit to that time existing partners. Okay? Then existing partners. The partner who will become, the person who will become partner after that point of time will not be enjoying that amount of goodwill. Okay? So we work out goodwill based on average profit or super profit or market capitalization. In fact, these are the three methods based on which we work out value of the goodwill of a firm. All right. So we'll see that how we work out goodwill based on this average profit method. And here is some information for this. There are past 4 years profits. The total of these profits is 180,000 rupees. It is agreed that goodwill of the firm will be equal to 3 years purchase of the last 4 years average profit. Remember, when we say 3 years purchase or 2 years purchase or 5 years purchase, it means that this average profit will be multiplied by this much time. Okay, we are buying this average profit this much times to work out goodwill. So conventionally we call it this much times or this much years of purchase. Okay. So in this question, it is 3 years purchase of last 4 years average profit. Okay. So the average profit is worked out simply that these are the 4 years total profit divided by 4. We get 45,000 average profit. So this average profit will be multiplied by 3, since it is agreed that the goodwill of the firm shall be equal to 3 years purchase of the average profit. So the goodwill is 135,000 under this average profit method. Let's see super profit method. Under this super profit method, these are the 4 steps that we will follow. Number 1, calculate normal profit by multiplying firm's capital with normal rate of return. So the firm's capital will be given and normal market rate of return will be given. We'll multiply that rate with the firm's capital to get normal profit of the firm. Then calculate average profit of the firm, as we have already calculated in the previous working. Okay. And calculate super profit by subtracting normal profit from the average profit. Okay. Now super profit. What is super profit? Which is we get by subtracting normal profit from the average profit. All right. So average profit is in fact the profit earned by the entity over the years. It is entity's earned profit. Normal profit is that we calculate based on the market rate of return or the normal expected rate of return. So that rate is multiplied by the capital. We'll have a working of all these steps ahead. So multiply the super profit by the number of years purchase. So let's see, considering the information given in 16.3, which is our earlier practice question, owner's equity is equal to 200,000 and normal profit is 18%, which is the market rate of return, multiplied by the owner's equity of the firm, which is 36,000. Our average profit minus normal profit will give us super profit. Average profit is 45,000 and normal profit is 36,000, means our super profit is 9,000. So the goodwill of the firm is equal to 27,000, means 3 years purchase. Okay, 3 years purchase of the super profit. Okay, well, so the thing is that either we'll be having 27,000 as our goodwill or we'll be having 135,000 as our goodwill as agreed upon. Okay, as the partners do agree that what will be the total amount of goodwill. Now comes third thing, which is market capitalization method. Here we have 2 steps. Calculate firm's market capitalization based on average profit divided by market rate of return. Okay, and then subtract book value of net assets from the market capitalization. So here we go. Considering the information given in practice 16.3 and 16.4, market capitalization will be 45,000, which is our average profit, as we have already calculated in practice question 16.3, divided by the normal market rate of return, which we worked out in 16.4, 18%. So it is 250,000 market capitalization. Means that this much amount of profit, means 45,000 would require 250,000 rupees capital if we earn this much profit from the market rate of return. Whereas our firm is earning this much amount of average profit by having an investment or owner's equity or net assets of just 200,000. What does it mean? That we have a goodwill of 50,000 with us. Once again, I repeat this thing. We are earning 45,000 rupees average profit by having net assets of 200,000. Whereas if we want to earn this much profit, 45,000, by having an investment in the market where the market is giving us 18% interest or return rate, we will be requiring 250,000 amount of capital. So we are earning this profit in just 200,000 capital, means that 50,000 is something which is our goodwill. So because of this much goodwill, we are making profit of 45,000, which is greater than the profit that we would have been worked out had this much amount been invested in the market. Well, so this is how we calculate value of the goodwill under the three methods: average profit method, super profit method, and market capitalization method. So the important tips to remember in this module are that number of years purchased means this much times. Okay, we have to multiply with the average profit or with the super profit. Okay, and it is mutually agreed that which method will be adopted to value the goodwill. So the partners will agree on a method, and that method will be used to calculate goodwill or value of the goodwill of the firm at the time of change in constitution of the partnership. Thank you.